Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, your resident tax nerd with a coffee habit, here to help you sell your business without tipping the IRS more than necessary. Today's episode is all about tax-smart exits for S Corp and LLC owners, when to choose an asset sale versus a stock or membership interest sale, how purchase price allocations drive your tax bill, and how to use earnouts and installment plans to manage both taxes and cash flow. If you're staring down a letter of intent or even just thinking about going to market in the next year, this one's for you. Quick disclaimer, this is education, not legal or tax advice. Talk to your CPA and your M&A attorney before you sign anything, especially that LOI. Let's start with the single biggest money saver, planning before you sign the LOI. I cannot stress this enough. Once the LOI sets the deal structure, asset sale versus equity sale, and hints at allocation and earnout mechanics, you're leveraged to optimize tax drops fast. Assemble your A-team early, a CPA who handles deal tax, an M&A attorney who negotiates tax language, and a broker or investment banker who knows your industry. Then run sell-side diligence on yourself, clean financials, confirm your S election and ownership, reconcile fixed asset schedules, tie out basis by shareholder or member, identify sales tax, payroll tax, and nexus issues that spook buyers. The cleaner your house, the better your multiple, and the easier it is to push for tax-favorable structure. Do this even before you shop the business. The dollars you spend now are usually paid back many times over in price and tax savings. Quick primer, S Corp versus LLC for tax purposes. Both are pass-throughs, so income typically lands on your personal return, but the mechanics differ. S Corp, you own stock. The corporation has inside basis in its assets. You have outside basis in your stock, which increases with retained earnings and contributions and decreases with losses and distributions. Distributions typically aren't taxable to the extent of basis. Compensation must be reasonable for owner-employees. S Corp sells assets and passes gain through, or you sell stock. LLC taxed as a partnership. You own a membership interest. There's inside basis in assets and outside basis in your interest. Special rules allocate liabilities to increase basis. When the LLC sells assets, gain passes through. When you sell your interest, most of the gain is capital, except for hot asset recharacterization under Section 751. Your outside basis matters a lot. It determines how much gain you recognize on sale. These basis concepts drive whether your proceeds are capital gains, ordinary income, or depreciation recapture, and how much you owe on day one. Asset sale versus equity sale. This is the fork in the road. Buyers love asset deals because they can cherry-pick assets and liabilities, and they get a fresh step-up in basis to depreciate and amortize. That step-up is tangible value. Sellers often prefer equity deals because they're cleaner, fewer assignments and consents, and for tax reasons, more of the gain is capital and there may be less ordinary income from hot assets. Here's the trade. In an asset sale, the buyer's step-up means a higher after-tax value to them, so they might pay more. But you, the seller, might recognize more ordinary income and depreciation recapture. In a stock or membership interest sale, your gain is generally capital, and you avoid some hot asset pain. Though partnership hot assets can still reach you under Section 751, buyers will often push back on price because they lose amortization of intangibles unless there's a workaround. Your negotiation is essentially about splitting that tax value pie. If you're selling an S Corp and the buyer wants an asset step-up, consider the Section 338H 10 or 336E elections. These let a stock deal be treated as an asset sale for tax purposes. With 338H 10, the buyer must typically be a corporation buying stock of your S Corp. With 336E, sellers can sometimes get to a similar place when buyers aren't corporations. Both elections create an inside step-up for the buyer, but can trigger asset-level tax consequences to the S Corp shareholders, including recapture. The price should reflect the tax cost to you. Model it before you agree. One more S Corp curveball: the built-in gains, big tax. If your S Corp used to be a C Corp and it's within the 5-year recognition period, an asset-style sale can trigger a corporate-level big tax on appreciated assets. That's a nasty surprise that effectively double taxes those gains. You must test this early, especially if you're considering an asset sale or 338 type election. LLC and partnership sellers have a very handy tool, Section 754. If you sell your membership interest to a buyer and the partnership makes a 754 election, the buyer can get a step up in the assets attributable to your purchased interest. That means the buyer largely gets the tax benefits of an asset deal, while you, the seller, still enjoy mostly capital gain on the interest sale, subject to hot asset recharacterization. It's not identical to a full asset step-up, but it's powerful and less messy than an asset sale. For buyers, that step-up amortizes over 15 years for intangibles and according to asset class for depreciables, which may justify a higher price without forcing the seller into recapture-heavy territory. Now to the engine of your tax result, purchase price allocation under IRC 1060. In an asset deal or a deemed asset deal like 338H10, the purchase price must be allocated across asset classes and reported consistently on Form 8594 by buyer and seller. The categories typically flow in this order. 1. Class 1, cash and cash equivalents. 2. Class 2, marketable securities. 3. Class 3, accounts receivable. 4. Class 4, inventory. 5. Class 5, fixed assets and land. 6. Class 6, Section 197, intangibles other than goodwill and going concern. 7. Class 7, goodwill and going concern. Sellers care because the allocation drives your character. Inventory and receivables create ordinary income. Fixed assets trigger depreciation, recapture. Real property may have unrecaptured Section 1250 gain at up to 25%. Section 197 intangibles and goodwill typically produce capital gain. Buyers care because allocations determine future depreciation and amortization. Negotiate allocation early and put bands in the LOI to keep everyone honest. Let's unpack recapture. For personal property like equipment, Section 1245 recapture recharacterizes gain as ordinary income to the extent of prior depreciation. If your assets are fully depreciated and you sell above tax basis, a big chunk can be ordinary income. For real property, Section 1250 applies. The portion of gain attributable to prior depreciation on real property, to the extent not already recaptured as ordinary income, is taxed as unrecaptured Section 1250 gain at up to 25%. This matters for installment sales. Inventory and depreciation, recapture, generally do not get installment treatment. You pay the tax on those in year 1, even if the cash comes later. So, if your business is heavy equipment or inventory, plan for a sizable year 1 tax bill in an asset structure, or negotiate allocations and structure to mitigate the ordinary income spike. Negotiation tip: shrink the hot assets. Hot assets are items that cause ordinary income. Inventory, accounts receivable for cash basis taxpayers, and Section 1245 recapture. Where commercially reasonable, consider selling receivables back to the seller through a pre-closing distribution or excluding them from the asset sale and adjusting price, tightening inventory counts and reserving for obsolete stock before the deal, minimizing non-compete allocations which generate ordinary income to you but amortization to the buyer. Instead, increase goodwill or consulting arrangements that are priced reasonably and fit the facts. A word on personal goodwill. In certain closely held service businesses, where the owner's relationships and reputation truly drive value, personal goodwill can be sold separately by the individual, potentially capturing capital gain and reducing corporate-level taxes in S Corp structures. But it must be credible. You need contemporaneous documentation, proof that goodwill is owned personally and not by the company via employment and non-compete agreements, and separate contracts. It's heavily scrutinized. If it looks like a tax gimmick, expect pushback. Earnouts are catnip for bridging valuation gaps and tax complexity. If your price depends on future performance, you have contingent consideration. How is it taxed? Generally, you recognize additional gain as earnout payments are received, along with interest or original issue discount, OID, accrual. If the total purchase price is unknown at closing, you might use the contingent payment installment method, recognizing gain based on payments as they come in. But here's the catch: interest. Earnouts often implicitly include OID, which you must recognize annually, even without cash, or you may need to impute interest. To keep it clean, spell out an interest rate or explicitly allocate some portion as interest. Cap the earnout and define the measurement mechanics. What metrics, who calculates, audit rights, and what happens on a sale of the buyer or change in control. Also plan for tax reporting. If the initial allocation and forms are filed without a fixed total, you'll amend or report supplemental allocations when contingencies resolve. Installment sales under Section 453 can be your best friend for smoothing the tax hit. The gist: you report gain proportionally as cash comes in by applying a gross profit percentage to each principal payment. For example, if your contract price is $10 million, your basis is $4 million, your gross profit is $6 million or 60%. Each principal dollar collected is 60% gain, 40% return of basis. Interest is separately taxable as ordinary income. What if there's no stated interest or it's too low? Sections 1274 and 483 impute interest using the applicable federal rate, AFR. If you understate interest, you'll get OID accruals that the IRS will happily tax you on. Structure notes with a market rate, often slightly above AFR for the term, and clear payment schedules. Match cash flow to your tax liabilities. And remember, if you plan to gift or transfer part of the installment note to a trust or family member, get counsel first. There are acceleration rules and gifting implications. Installment sale gotchas to watch. No installment treatment for inventory and depreciation recapture. You'll owe that tax in the year of sale, even if the cash hasn't arrived. 453A interest charge on large installment sales. If the face amount of installment obligations exceeds $5 million, you may owe an annual interest charge on the deferred tax. Factor that into pricing. Acceleration events, selling, pledging, or otherwise disposing of the installment note can trigger gain as if you were paid. The pledge rule is especially dangerous. If you use the note as collateral for borrowing, or if it's effectively pledged, you can be treated as if you received payment. Escrows and holdbacks. When are they taxed? It depends on whether the right to the funds is fixed and what contingencies exist. Earned but escrowed funds may be taxable at closing. Truly contingent amounts may be recognized when released. Draft your purchase agreement to align tax with economics. Related party installment sales have their own traps. Don't DIY this. Security and financing terms make or break your tax deferral. To protect yourself while preserving installment treatment, use a properly drafted promissory note with market interest. Secure the note with a UCC filing on assets or a pledge of stock membership interests, but avoid arrangements that violate the pledge rule by effectively monetizing the note. Consider personal guarantees from the buyer's principals if appropriate. Coordinate with buyer's bank. Your seller note is often subordinated. Make sure the subordination doesn't morph into a pledge that triggers acceleration of tax. Working capital targets, escrows, and indemnities also affect tax. A working capital true-up generally adjusts purchase price. Escrows can be treated as part of the amount realized at closing or deferred, depending on contingencies and drafting. Indemnity payments after closing may reduce gain or create ordinary deductions. Again, drafting and tracking matter. Keep schedules of every dollar flowing so your tax reporting matches the deal mechanics. State and local tax planning is not optional. In asset deals, state tax follows the assets and business activity. Goodwill allocated in an asset sale is typically business income apportioned among states, so you could have filing obligations in multiple states. In equity sales, gain on intangible property, stock, or an LLC interest is often sourced to your state of residence, and non-residents may avoid tax in the business's states, but watch exceptions. Non-resident withholding can bite in some states, especially for pass-throughs. Some states require withholding on distributions or sale proceeds to non-residents. Sales and use tax exposure, successor liability, and bulk sale or tax clearance procedures should be resolved pre-closing so the buyer doesn't hold back more cash than you expect. Transfer and recordation taxes can apply to real property in an asset deal. Missouri note. Missouri generally does not impose a state-level real estate transfer tax, though recording fees and local costs apply. Missouri also has successor liability and may require tax clearance for sales, use tax, and withholding. Non-resident partners or S shareholders can face withholding through the entity. Always confirm state-specific rules well in advance. Let's hit the 3.8% net investment income tax, NIIT, and self-employment tax angles. NIIT applies to passive income for higher income taxpayers and can apply to capital gains from a business sale if you're not materially participating. Active S Corp shareholders usually avoid NIIT on the sale of stock, but passive owners may not. In partnership and LLC settings, hot asset ordinary income can be subject to self-employment tax, whereas capital gain on the sale of an interest generally isn't. For S Corp, scrub reasonable compensation before closing. Underpaying W-2 wages can prompt reclassification headaches. Also review shareholder loans and distributions to ensure S-election integrity. No second class of stock, no ineligible shareholders. If your S-election is defective, it can blow up deal tax modeling. Fix what you can before the LOI. Retroactive cleanup gets exponentially harder once a buyer's diligence team is in your books. Due diligence cleanup list. Make it boring and complete. Payroll tax filings reconciled to W-2s, no unpaid trust fund taxes, sales and use tax compliance, including marketplace and economic nexus reviews, state registrations in every state where you have nexus, withdraw in dead states, fixed asset subledger tied to tax depreciation schedules, proof of placed in service dates, contracts and leases, assignability and change of control clauses flagged, confirm shareholder or member basis, including debt allocations for partnerships. Review depreciation methods and bonus depreciation claims. Document Section 179. Ensure your cap table is accurate. Yes, I'm looking at you with the dusty stock ledger. Every red flag either reduces price or shifts the structure toward a buyer-friendly asset deal. Don't give buyers ammunition to demand allocations that hammer you with ordinary income. Cash flow planning. Selling your business is amazing until the tax estimates arrive. Coordinate the buyer's bank financing, your seller note terms, and the timing of earnouts with your estimated tax payments. Map out a payment waterfall, senior bank debt to the buyer, your seller note, escrows, and earnouts. Then schedule quarterly estimates to avoid underpayment penalties. If you're using an installment sale, remember that interest doesn't reduce your capital gain. It's separate ordinary income. Keep some dry powder for both federal and state taxes, especially if multiple states will claim a piece of the asset sale via apportionment. I often create a closing day cash and tax dashboard, so there are no surprises at April 15th. Wealth and charitable planning before the deal can be rocket fuel for after-tax outcomes. A few ideas to discuss early. Donor-advised fund, DAF. Contribute some equity before the LOI is binding and before you're effectively obligated to sell. That can generate a charitable deduction at fair market value and avoid capital gain on that portion, if done correctly. Charitable remainder trust, CRT. Contribute interest pre-sale. The CRT sells. You get a partial deduction and an income stream over time, deferring recognition of gain within the trust. Complex but powerful. Opportunity Zone OZ reinvestment. Eligible capital gains can be reinvested within 180 days into a qualified opportunity fund to defer tax and potentially reduce future tax. Note: only certain gains qualify and rules are nuanced. Timing is everything. If you try to donate after the deal is effectively locked, you risk the assignment of income doctrine and lose the tax benefits. Coordinate with counsel and the buyer's timeline. Case study number 1, S Corp asset sale with heavy equipment. Imagine a regional landscaping S Corp with $8 million purchase price and lots of fully depreciated equipment. Tax basis in equipment is near zero. There's also some inventory and customer lists. Allocation negotiation. The buyer wants more to equipment for faster depreciation. The seller wants more to goodwill to avoid ordinary income. They settle with a reasonable fixed asset schedule supported by appraisals, a fair amount to Section 197 intangibles, and minimal non-compete value. Tax result. Section 1245 recapture on equipment is ordinary income up to prior depreciation, substantial in year 1. Inventory sold creates ordinary income as well. Goodwill and going concern produce capital gain. If the seller uses an installment note for $3 million, the recapture and inventory tax hit still largely lands in year 1. Only the capital gain portion over basis spreads. Earnout overlay. A $1 million capped earnout based on gross margin adds contingent payments. The seller recognizes interest on the earnout accrual if OID applies, and capital gain when amounts become fixed or are received depending on structure. The LOI states the framework and caps. The purchase agreement bakes in measurement mechanics and dispute resolution. The seller sets aside cash for year 1 taxes despite the earnout and note, avoiding penalties. Case study number 2, LLC membership interest sale with a Section 754 election. A software development LLC sells 100% of membership interest to a strategic buyer for $15 million. The company has very little fixed assets. Most value is customer relationships and workforce in place. Classic Section 197 intangibles. Structure. The seller prefers an interest sale to preserve capital gain. The buyer wants amortization. Solution. Buyer purchases interests. The LLC makes a 754 election, giving the buyer a step up in the underlying assets attributable to the purchased interests. Installment. $10 million at closing, $5 million via a 3-year seller note at AFR plus 300 basis points. Gross profit percentage method spreads gain on the installment portion. Interest income is recognized as paid or accrued. Tax result. Most gain is capital. There's minimal hot asset recharacterization because there's little inventory or receivables. The buyer gets amortizable intangibles via the 743B step-up from the 754 election, improving their after-tax ROI without pushing ordinary income onto the seller. Both sides win and agree on a slightly higher price to reflect the buyer's tax benefit. What to lock into the LOI so you don't wrestle with it at midnight later. Deal structure. Asset sale versus equity sale, and whether a 338H, 10, 336E, or 754 election is intended. Allocation bands, high-level ranges for inventory, fixed assets and intangibles, plus treatment of non-compete and personal goodwill if applicable. Earnout framework, metrics, caps, timing, and whether interest applies. Installment terms, interest rate, security, subordination basics, and any prepayment limitations. Working capital target methodology and timing of true-up, escrows and holdbacks, purpose, duration, and whether amounts are treated as contingent purchase price. State tax responsibilities, who bears transfer recording costs, bulk sale clearances, and non-resident withholding obligations. The LOI is where leverage lives. Use it to shape the tax outcome before momentum and deal fatigue make everyone say yes to the path of least resistance. Close-out checklist once the ink is dry. Form 8594. Buyer and seller both file, matching the final purchase price allocation. Form 6252. Report installment sales and track gross profit percentage annually. Form 4797 and Schedule D. Form 8949. Report ordinary income from recapture and capital gains correctly. For NIT, ensure proper calculation, and if applicable, file the necessary form for the 3.8% tax. State filings. File in each state with asset sale sourced income. Non-resident returns as needed. Address withholding credits. 4553A interest. If applicable, compute and pay annually. Update estimates. Recompute federal and state quarterly tax estimates for the year of sale. S Corp final touches. If asset sale, consider whether the S Corp will liquidate. Manage distributions and basis tracking for shareholders. Books and records, archive deal docs, appraisals, and allocation support. Keep a schedule of escrows, earnouts, and note balances for future years. If you're thinking, that's a lot of forms, you're right. But clean reporting is what keeps your deal from becoming an audit hobby project. Alright, let's land this plane. Today we covered why pre-LOI planning sets the stage for a tax-smart exit, the fundamentals of S Corp and LLCs and how basis drives outcomes, the asset versus equity decision and the elections that can bridge the gap, the mechanics of purchase price allocation and how to tame hot assets, the realities of depreciation, recapture, and its impact on installment sales, the ins and outs of earnouts, OID, and imputed interest, installment sales strategy, 453A interest and the pledge rule, security terms, working capital, escrows and indemnities, state and local tax pitfalls, including Missouri notes, NIIT, self-employment exposure, and S Corp housekeeping, the diligence cleanup list, cash flow and estimates, pre-sale wealth and charitable planning, and 2 case studies showing how all these ideas play out in the real world. The value here is simple. A smarter sale starts with smart tax planning. Get your team in place, model your options before you sign the LOI, and negotiate allocations and structure with open eyes. If you found this helpful, subscribe to Tax Smarts Unlocked, share it with a fellow owner or advisor, and send me your questions for future episodes. I'm David Robson. Thanks for listening, and may your earnouts be achievable and your recapture merciful.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.